Okay, let's dive right into this explainer because Bit Digital has completely re-engineered the way public markets approach digital assets. For any institutional investor or allocator looking at the current landscape, the old legacy models are quickly becoming totally obsolete. Today, we're looking at a fundamental shift in capital allocation towards what Bit Digital is calling the strategic asset company model.
And it all stems from this multi-million-dollar question, the one that's literally keeping institutional allocators awake at night. How exactly do you get pure play exposure to the two most transformative technologies of our time without completely destroying your per-share value in the process? Because historically, crypto-native companies just issue more stock to buy more assets, which, let's be honest, punishes the exact shareholders they're supposed to enrich. Bit Digital actually set out to solve this exact problem.
So here's our game plan for this explainer. We'll start with the scarcity thesis, move into the strategic asset company model, break down their dual pillars of Ethereum and AI, and then cap it off with their non-dilutive lever and institutional-grade security.
All right, first up, the scarcity thesis.
Bit Digital's entire macro view centers on one absolutely crucial concept. Infrastructure is the ultimate scarce asset. Think about it. We are currently witnessing the rapid convergence of two massive, long-duration systems. On one hand, you have Ethereum acting as the global economic layer, coordinating value, ownership, and execution all on-chain. And on the other, you have artificial intelligence acting as the intelligence layer, which requires just a massive amount of reliable, capacity-constrained compute power. Until now, public markets have really lacked clean exposure to these foundational infrastructures.
Moving on to part 2. The strategic asset company. To capture this massive scarcity, Bit Digital completely evolved its corporate structure. The key takeaway here is that they aren't just passively sitting on volatile assets, hoping the price goes up. No, they're actively operating an infrastructure-driven growth model. A strategic asset company balances active participation in the Ethereum network with a controlling equity stake in AI and high-performance computing. It's a dual exposure model built for long-duration, compounding performance, rather than just trying to time cyclical price swings.
Let's unpack that first pillar in Section 3, Ethereum as economic infrastructure.
Tracing their moves back to 2022, you really have to hand it to management's foresight here. They started accumulating ETH alongside their legacy Bitcoin mining, but then, by 2024 and 2025, they executed this brilliant, hard pivot away from the highly capital-intensive mining cycle, moving straight toward a pure-play Ethereum treasury model. Fast forward to July 2025, and they completed a $67.3 million offering to aggressively expand those holdings, essentially building one of the largest on-chain Ethereum balance sheets in the public markets today.
And the sheer scale of that execution, it's staggering. By the end of 2025, Bit Digital held over 155,000 ETH. To put that in perspective, they went from roughly 30,000 ETH at mid-year to this absolute behemoth of a number by year-end. But here's where it gets really interesting. They didn't just let that ETH gather dust in a digital vault. They put it to work. They actively staked nearly 89% of their holdings to earn protocol-native yield. And this isn't just theory. This risk-aware staking strategy generated almost 1,989 ETH in direct rewards during 2025 alone. They're securing the network and getting paid for it, turning a static asset into a highly productive, yield-generating foundation.
Which perfectly tees up Section 4. AI as intelligence infrastructure.
$275 million. Let that number sink in for a second. That is the second pillar of their dual exposure and action. That figure represents the total value of an expanded 3-year contract to supply a major customer with over 4,000 AI GPUs. Through their roughly 70% majority ownership of WhiteFiber, their high-performance computing subsidiary, they deployed Dell servers equipped with NVIDIA H100s into specialized data centers in Iceland. And get this, it's running on 100% renewable energy, instantly turning compute power into cash flow.
The financial impact of that execution is crystal clear. They drove a massive 50% year-over-year spike in cloud services revenue, leaping from $45.8 million in 2024 to $68.8 million in 2025, alongside a sharp jump in colocation services. This absolutely proves their AI infrastructure thesis isn't just some corporate buzzword, it is a live, compounding, high-margin revenue engine.
All right, moving into part 5. The non-dilutive capital lever.
Honestly, I consider this to be the absolute climax of this explainer. This is how they protect your investment. Remember that problem we established at the beginning? Pure-play crypto treasuries historically dilute their shareholders into the ground to buy more assets. Bit Digital fundamentally rejects that approach. Their entire structure is built around a relentless commitment to preserve ETH density. That means your specific ETH per share metric is heavily protected.
Let's walk through how this mechanical genius actually works. Step 1. They maintain majority equity in their AI business, WhiteFiber. Step 2. They use that cash-flowing AI asset to raise capital, like they did with their $135 million convertible notes offering. Step 3. They use those exact proceeds to acquire more Ethereum. And Step 4. They dramatically grow the total ETH on their balance sheet without ever having to issue more BTBT stock. It's a brilliant, non-dilutive lever that pure-play ETH treasuries simply do not possess.
Finally, Section 6. Institutional grade and scale.
Look, none of this economic engineering matters if the vault isn't secure, right? That is exactly why Bit Digital surrounds this dual exposure with an absolute economic fortress. We're talking Tier 1 custody providers, multi-sig controls, and fully audited smart contracts. When they stake that Ethereum, they exclusively use institutional-grade validators, like BlockDaemon, that target near 100% uptime with super strict slashing protections to shield the principal. Plus, as a fully transparent public company listed on the Nasdaq, you get routine SEC disclosures and robust governance.
And the heavy hitters are clearly paying attention and validating this structure. Just look at the massive financial institutions that already hold major stakes in the company. You've got BlackRock holding nearly 8%, along with State Street, Invesco, Citadel, and Geode. These aren't retail day traders, folks. These are sophisticated Tier 1 allocators who clearly recognize the value of having clean, non-dilutive exposure to foundational infrastructure.
So, let's tie it all together. Bit Digital has completely transitioned away from the painful legacy digital asset mining model. They left behind the incredibly cyclical revenues, the massive capital expenditures for new rigs, and those highly dilutive practices. In its place, they built a strategic asset company, an absolute powerhouse, combining yield-generating Ethereum, high-margin AI compute, and a structurally protected per-share density.
Which leaves us with a pretty massive question to chew on as we wrap up this explainer. As the global financial systems are entirely rewritten by Ethereum and our intelligence systems are rewritten by AI, how is your portfolio positioned? Are you holding the foundational, scarce infrastructure of tomorrow, or are you just trying to trade the cycles? It's a phenomenal model from Bit Digital, and it's absolutely one that is reshaping how the world's largest allocators view the future.